Okay, good afternoon. I'm Jared Brevy from Pinnacle Investment Management Group, and we thank you for joining us for this Meet the Manager session. We're aiming to drown out the noise and focus on what matters most with Blake Henricks, a portfolio manager at Pinnacle affiliate Firetrail Investments, and Michael Bell, the CIO of Pinnacle affiliate Solaris Investment Management. A very brief overview for those not familiar. Firetrail is a high conviction manager of Australian and global equities. The senior investment team has a long track record of achieving great outcomes for clients, having worked together at Macquarie before founding Firetrail in 2018. And Solaris is a style-neutral Australian equities manager with a strong track record of over 20 years. The Solaris core Australian equity strategy has outperformed the S&P ASX 200 accumulation index 17 out of 22 years since the strategy's inception. So let's get into it. First, here's Blake Henricks with Firetrail's perspectives on what matters most right now for Australian equities. If I can remind you to start sharing your screen, Blake, and take yourself off mute if you are muted.
Okay, great. Thanks, Jared. Thanks for the great introduction. I'll just make sure I'll put this in PowerPoint mode and just confirm you can see that, Jared?
Yes.
All right, great. Well, thanks very much for joining us this afternoon. We're talking about what matters most for 2023. And so what I wanted to do was run through a couple of things. To start with is, I guess, a bit on the macro. I wanted to touch on why the consumer's been holding up and also what we're seeing out of the banks. Secondly, I'll share with you why it is today a stock picker's market and why it's important, and probably more important than ever, to be able to invest in both value and growth. Why being tied to one style really does put yourself at risk of style bias over time and material underperformance. The Firetrail High Conviction Fund is a concentrated portfolio with a proven track record, and let's get into it. Now, the question everyone's got is, why is the consumer holding up so well? And what I think is really interesting is that the data to date has been much better than everyone thought. This has been the best called recession. It's always just 6 months away. We've been saying this for probably about 18 months now. When we look at ABS statistics, what we find is that costs are up. So if you look at this orange line, this is the average Australian household and how incomes and costs have changed in any particular year. And so what you can see, let's start with the blue lines. Change in income, we've seen income growth across the board, and in 2024, it's likely to be stronger than it has been in those years. And while everyone's very focused on cost of living and inflation, you can see these orange bars here, those costs are up. Incomes have broadly matched costs in FY23. And so I think that's why when you go to the barbecue and everyone talks about things, it's rarely someone tells you they just got a pay rise. It's rare someone tells you they got a promotion. What they're most likely to talk about is how expensive, the avocado was, which I saw in the paper today. So everyone likes to talk about costs, but the truth of the matter is the average Australian household has their costs and revenue broadly matched in FY23. And that's why the consumer's holding up so well on average. And I'll say on average, because we recently did a trip to the US and met with Treasury Wine, and we saw some data. And what's really interesting is while the average consumer's holding up well, it's very different depending on how much you earn. If you look at less than $4.50 a litre, you can see that category in terms of demand is down close to 7%, while greater than $50 a litre, that category is up 8%. And we've seen this again and again across many different sets of data where lower income consumers are relatively worse off because they spend more on staples and utilities, while the higher end consumer is much better off. And we even saw a trading update today from Qantas, which confirms that the flying household, which is usually the upper household, is doing very, very well. So why is the consumer holding up so well? It's because higher wages are offsetting inflation on average. One of the other things I think you need to know for 2024, and talking about drowning out the noise, is that the banks, the best of the banks, is behind us. The story of last year, of 2022, was really that higher interest rates were really going to benefit banks. And the reason for that is they have a lot of current accounts, and as rates go up, they don't pass that on, and so they earn higher margins. What you can see here is Commonwealth Bank's net interest margin, and you can see that rally from broadly December 21 through last calendar year. But what happened in October, November is that rally stalled. And in fact, net interest margins have peaked, and the bank reporting season this year showed us that the best of the banks is behind us. Some of the competition we've seen is very aggressive. So home loan pricing across the industry is below the cost of capital. We caught up with ANZ recently. They're looking to remove cashback. So if you are looking to move mortgage provider, I'd instruct you to do so immediately, because many of these cashbacks are going to leave the industry because these ROEs on home loans are in the single digits at the moment. The key point here is that bank margins have peaked. And in terms of positioning, what does that mean? Well, for the high conviction strategy, we own no shares in Commonwealth Bank, no shares in Westpac, no shares in NAB, and a small holding in ANZ. Bank margins have peaked. Now, 2023 is really set up for stock pickers in our view. What you can see here is a chart of how correlated the ASX 200 shares are within each other. So the constituents, how much are they moving together? And what you can see looking back over a long period of history is that 2023, as rates have risen, stocks became very correlated. In fact, much more so than almost any time in history besides COVID, when everything moved together. And so those kind of conditions typically aren't conducive to bottom-up stock picking. But what we do see is, and expect, is a reversion back to some kind of more stock-specific drivers of returns rather than just our interest rates going up or down. And those market conditions were well set up for bottom-up stock pickers like Firetrail. Now, at the outset, I mentioned the importance of being able to invest in both value and growth companies. And what I wanted to do now is share with you two large positions in the portfolio today, one in value and one in growth. Oh, before I do that, I should know what I'm about to present. Just to share with you portfolio positioning. Today, the High Conviction Fund has 27 stocks in it. It has a very high active share, 76%. I mean, to put that in context, according to Morningstar data, the average or the median manager for active share sits below 50%. So this is a very highly active portfolio. Today, the portfolio owns shares that are going to benefit from higher energy prices, as we believe underinvestment, which has really been going since 2014, continues to require higher prices to incentivize new supply. We are also exposed to global growth, mostly in the form of healthcare, companies like CSL and ResMed, who have very unique drivers, but very defensive and solid earnings growth that we believe is going to be very defensive, especially as things slow down. And then also we are overweight value stocks. So this could include both rising rate winners like a QBE, Virgin Money, also some undervalued defensives like a Newcrest, which is recently the beneficiary of a takeover bid. The portfolio, as I mentioned up front, is underweight banks, heavily underweight banks, in fact, but also iron ore, where iron ore stocks look okay, but we just think with iron ore still over $100 a share, some of those companies are at risk of underperforming. So if we sit here today, it really is a concentrated portfolio of our best value and growth ideas. Now, QBE is a value stock. And in fact, if we're sitting here 18 months ago, many of you would have virtually anyway groaned and said, this is a stock that's showed so much potential, but has disappointed on and on again. QBE is a simplified business. Since the heady days of the late 2010s, should I say, where acquisitions fed into the portfolio, few were integrated, reserves were taken. We've seen now a period really of about 8 years of simplification at QBE. The most recent increase in gross written premium, which really is the insurance you're writing, the most recent period has been driven by higher premiums, and that's been driven by increased losses across the industry. So we're in a really strong insurance cycle at the moment. QBE has had 30% cumulative price increases over the past 2.5 years. This is one of the strongest cycles we've seen for insurance, both in Australia, but also globally where QBE operates. And so our view is that the perennial disappointment tag that's been applied to QBE is in the rearview mirror, and this company is set for even further outperformance. Our view is it's much better than the banks. The core insurance business has improved. And if you look at this chart here, this is combined operating ratio. And what that is a measure of the profitability of QBE, where a lower number is a better number. And you can see in FY22, they reported around a 92% margin. Now, the market's not giving much benefit for this because the stock today is trading on around 8 to 10 times PE. And so the market doesn't believe these returns are sustainable. Our view is they are. QBE has also had the benefit of rising rates. and it's one of the most levered stocks to rates in the ASX 200, where a 1% move in interest rates can move the EPS by 17%. Now, we don't believe that interest rates are going to go a lot higher, but equally, we don't believe they're going to come back a long way either. And so some of these benefits that have flown through into QBE's P&L are going to stay in place in our view. And so QBE's earnings are improving, and the stock's trading on, as I mentioned, 10 times PE. Now, if we move across to growth now, ResMed is one of Australia's great growth companies, in fact, one of the great global growth companies. They treat breathing disorders such as sleep apnea, and I'm sure many of you know someone, maybe even yourself, have sleep apnea and would use a ResMed device. The great news for ResMed is that they operate in a very large potential market. We believe less than 20% penetrated. If we look in the US, they're probably around 15 to 20% penetrated, and then there's an even bigger market outside of that. So ResMed is and has been a market leader in an attractive industry, but that alone isn't enough for us at Firetrail to take a position. We always want to have an edge, have an angle on a company using our in-depth research. And in the case of ResMed, it has a once-in-a-lifetime opportunity. ResMed operates in a three-player market. They are the leader, then it's Philips, and then it's Fisher & Paykel. And Philips, the number 2 player, had a major product recall in June 2021. Now we're sitting here 2 years on, and it's going to get worse for Philips. What was happening was the machine that sits on the side of your bed had foam in it, and that foam could degrade and end up going into your mask, and you could be inhaling broken down memory foam. That's very, very dangerous, and the FDA in the US forced them to recall millions of devices. Now, when we look back at what happens when recalls happen, it's very good for the incumbent player. We went back to have a look at what happened to Cochlear back in 2011. You can see here, Cochlear's market share post a recall declined for almost 10 straight years before finally recovering share. Now, the market's view today is that Philips will be back maybe in a year, although they were saying in a year, about a year ago. We think this will be an elongated recall. The best people from Philips have left. They're going to be facing major fines, and ResMed's going to take serious share, and we believe stay at a higher level of market share into the future. Now, the great news for investors, hasn't been particularly good for Firetrail so far, is that this share price really hasn't outperformed the market despite the recall in June 2021. Now, part of the reason for that is because ResMed hasn't been able to take full advantage of the market share opportunity. The shortage of chips meant they couldn't make as many devices as they needed. That's now rolling off, and we believe, especially over the next year, ResMed are going to show the market how strong the business is and how big the opportunity is with Philips out. ResMed really is a standard opportunity with underappreciated growth. So let me put it together for you. The topic today is drowning out the noise. 2023 really is set up for stock pickers. We strongly believe that the consumer has been okay to date because revenues have outweighed costs, looking at the consumer like a company, but the lower income earners are really getting hit quite hard. We also saw the best of the banks are behind us, and also that stock correlations have reached a historical peak and are likely to come down, favouring active management. We talked about QBE being better than the banks. It's a real turnaround story, and also the underappreciated growth in ResMed, which we believe has many years to run. I really appreciate your time and dialing in today, and really invite you to join us as investors in the Firetrail High Conviction Fund, where we implement concentrated portfolio with a proven track record. I might hand over to Michael now, where he'll do his talk on behalf of Solaris. Thank you.
Thanks, Blake. Thanks, Jared, and appreciate the introduction. Now, I'll give you a second to read the disclaimer before I move on. Now, at Solaris, one of the most common questions we get from new analysts at Solaris is, how do we assess companies? And you can see the 6 qualitative factors that we look at when we're looking at companies. And they're all important, and all important at different times throughout their cycle. And they're important across both companies and sectors and periods. And today I'm going to talk about two of those factors that are really important today, being balance sheet and industry structure. And when I'm talking about balance sheet, I'm talking about having fit-for-purpose balance sheets. So a toll road, for example, can have a significant amount of debt on their balance sheet, and they can have that because they've got defensive cash flows. A building materials company, which has very cyclical earnings, which can swing from profits into losses, needs to have a much more conservative balance sheet. So having an eye on balance sheet is really important. Now, industry structure is another important qualitative factor that we look at closely. And what we're trying to do is trying to work out whether a company should trade at a premium because of its industry structure or at a discount. And what we're looking at when we're thinking about industry structure is, does the company operate in a concentrated industry or a fragmented industry? Do they have pricing power? Are there barriers to entry in that particular sector, and how competitive that sector is? And they're all factors that go into deciding whether there is a premium or discount there. Now, what I'll do in the rest of the presentation is delve into those qualitative factors of balance sheet and industry structure and give you a couple of examples. But before that, I'm going to go back in history and take you back to about 8 years to a company called Arium Steel, and it was previously One Steel. And they're a company that produced steel products, iron ore, and at times they're a very profitable iron ore operator, and they went into losses, and they also produced mining consumable products. Now, the part of this page that really grabs me is that share price. So the share price went from $3 to broke in 2016. They peaked at $7.80 in 2008, and they had a $6 billion market cap. So they were a significant company. And as active managers, we don't need to own these companies. And so balance sheet is extremely important. And I'm going to tell you why now. So on the left there, we've got the iron ore price. And what strikes me about that iron ore price chart is the volatility we see in the iron ore price. So we see it going from $80 to $180, back down to $50, and then more recently up to $200 a tonne. Now, you've got to bear in mind that Arium was a company that had, on our estimates, a cost of production in their iron ore operations at about $80 to $90 a tonne. So quite a high cost of operations. And what they did in 2011, or around 2011, is they increased their iron ore exposure. They acquired a business, and then they put a whole stack more money into iron ore, and potentially at the top of the cycle. And how'd they do this? They did this by increasing their debt. So the chart on the right shows you the debt increase you've seen. So from 900 million all the way up to 2.2 billion. So what we're seeing is significant increase in debt here. So this company has both operational leverage and financial leverage. And from a balance sheet perspective, when balance sheet matters, that's what we don't want to see in cyclical companies. So we never invested in Arium Steel at all. And the difficulty with Arium Steel is in 2015 on that iron ore chart, you can see where it hit its lows at $50 a tonne. That's when Arium went out of business. So at the time in 2014, the chairman came out and said, I think the balance sheet was appropriately geared for the time. We have no control over the iron ore price. Now, I agree with their comment about we have no control over the iron ore price. No CEO has control over the iron ore price, the lithium price, the gold price, the gas price, or the oil price. But what we want to see from companies we invest for our clients is we want to see solid balance sheets that see them through that period, because we have no control over that price. And for Arium Steel in the period 2015 to 2017, they were making losses. But you add on the leverage that they've got from the balance sheet and they go out of business pretty quickly. So if we apply this to one of the companies we've got in our portfolio that we really have high conviction on, Pilbara Minerals, this company is a lithium or spodumene producer, so 6% lithium. They're not only an explorer, so they're a producer, they're making real cash flows. They're in a tier 1 jurisdiction being Australia. They've got a 30-year mine life. They're a low-cost quartile producer. And most importantly for us, they have a strong balance sheet. They've got a strong balance sheet. So you can see it on the right-hand side. So In contrast to Arium, where you've got 2.2 billion of debt on the balance sheet, at the end of 2023 in June, we expect them to have 2.5 billion in cash. So like Arium, the spodumene price is pretty volatile. We've seen a big increase in the last couple of years, and more recently you've seen it come off a bit. Now, if we get our forecast for the lithium price wrong in the short term, they've got a balance sheet to see them through. They're not going to get stopped out like Arium. We're quite prospective in terms of lithium demand and prices in the future. So we're pretty confident in that stock. But if we do get it wrong in the short term, that company is still going to be there in the future and they're going to see those higher prices. So that gives you an idea of how we think about companies and balance sheets and why balance sheet for cyclical companies is particularly important. And if you're talking to fund managers about cyclical stocks, the first thing you should ask is, what does the balance sheet look like? So in terms of industry structure, I've talked about that, but at the moment, where there's significant change in terms of in the industry, in terms of higher inflation coming through across a number of sectors, and we've seen that in the economy. And so industry structure really matters. So two stocks we've got in our portfolio, Coles and Suncorp, have very strong industry structures. So in the case of Coles, it is a concentrated sector. They're not very fragmented. They have very strong pricing power. And in this environment of rising inflation, they've been able to pass on these higher costs to consumers, and they've been winners in the process. So we've seen significant earnings growth as a result. But these periods of high inflation, they're going to dissipate over time. So you need something more than just high inflation. They've also been investing heavily over the last couple of years in their supply chain. And what you've seen is that they'll start bringing on automated DCs in Brisbane and Sydney. And then on the online side, they're also going to bring on an automated DC in Sydney. This is going to be a game changer for Coles in terms of their cost side. And that chart down the bottom shows you, the red line, shows you the narrowing of gap between Coles and Woolies in terms of that EBIT margin. And that's a significant change from going from 5 to 6% on our forecast in terms of profitability. So you can see the benefit of industry structure for Coles and their pricing power. If I take that over to another company in the portfolio, Suncorp. So Suncorp has seen extremely strong premium growth over the last 12 months, and going forward, it looks good as well. And so you see numbers to the tune of 15 to 20% across both home and motor. And this is offsetting high claims inflation and reinsurance costs that have been coming through, and more than offsetting that. Now, what we really like about Suncorp, and we saw a stable industry structure with Coles, but in the case of Suncorp, we've seen improving industry structure. And why is that? And that's because the challenger brands have been struggling over the last few years in terms of catastrophes, that higher claims inflation, and those higher reinsurance costs. So that's a real game changer for us, that industry structure changing. In addition to that, interest rates going up are a positive for the investment yields of Suncorp. And the sale of the bank, which we expect in July, August, a decision by the ACCC, should be positive for Suncorp. And we expect to see significant capital releases and special dividends. Now, that all sounds pretty good. There's a lot of positives going for Suncorp. But what really excites us is where they trade relative to market. So they're trading on cyclical lows. They're trading at a 40% discount to market versus the average at a 20% discount to market. And a company that is showing the positives that they're showing should trade closer to a 10% discount. So we're seeing significant upside in terms of Suncorp. So to wrap it all up, what matters? Well, all those qualitative factors matter in this market and in any market. It's a volatile market for active managers, but this is no different to any other market that we've seen in the past. What really matters that I've spoken about, so I've spoken about balance sheets, and balance sheets matter, and having the fit-for-purpose balance sheet is really, really important. And I showed that with Arium Steel and what could happen if you don't have the right balance sheet. But if you have the right balance sheet and you can get through the cycles, and you can't control the particular commodity or whatever it may be, and you've got the balance sheet, you can get through. Industry structure is really important as well, and that's been demonstrated by strong pricing power across both coal and Suncorp. So we're rated by Morningstar across those three products we've got there in terms of the Solaris Core Fund, which we have via the PA account, and it's got a 0 MER, which is quite attractive. In terms of the long short fund, we've got the 130/30 product, and the Solaris Income Fund is relatively new to our suite, but is an extension of the Solaris Core Fund. It invests in both growth and value and has a yield and franking well above market. And you can contact Pinnacle if you need any further information. Thanks, Jared.
Thanks, Michael and Blake. We do have some time for a short Q&A. Let's just go to this top question, maybe to you, Blake. Aussie M&A activity seems to be in the news more and more each week. Do you expect this to continue, and who are the likely beneficiaries?
Oh, the beneficiaries would be our whole portfolio, Jared. So thanks for that question. No, in all seriousness, we've seen a lot of M&A in recent times. The Firetrail portfolios have benefited from a takeover by Newmont of Newcrest, and also more recently Origin and Brookfield. So M&A is kicking off. The IPO cycle is at a low point for sure. But when we're talking to people who acquire companies, particularly if they're offshore based, they're looking at Australian companies, looking at the Aussie dollar and saying, geez, I can buy these stocks cheaper than I could probably 5 years ago on a currency adjusted basis. And I think the companies that are going to be most at risk are companies with really good balance sheets, like Michael talked about extensively, that could perhaps take some gearing for a more aggressive mindset. One company I'd call out that we've been buying pretty actively would be Incitec Pivot, where they've already sold a business at the top of the cycle. That's yet to close. But once that closes and potentially then a demerger of fertilizers, this will be a very strong business with growth in it and explosives and a net cash balance sheet. So, if I'm looking for candidates, I'd be thinking about balance sheets first and then thinking about assets that perhaps could be better run or also strategic assets.
Yeah, let's stick to balance sheets. Michael, are balance sheets considered important in all circumstances or only when interest rates are rising? And are there any sectors that look vulnerable to high debt levels currently?
Yeah, thanks, Jared. So balance sheets are important at any point in the cycle. And that case on Arium just showed you that regardless of where interest rates are, if your underlying business is not going the right way and you're making losses and you can't then pay your debts, then you can still go under. So balance sheets at any point in the cycle are important. Are there any companies that are vulnerable at the moment? We've done a lot of work over the last 12 to 18 months in terms of balance sheets, looking at who were the winners when interest rates went down in terms of earnings and distributions to identify both long opportunities and short opportunities for us. And we found a lot of short opportunities for our long short product in the property trust sector. So they were a sector that had a lot of fixed, had a lot of floating rate note debt. And so they're beneficiaries on the way down, but on the way back up, they get impacted pretty quickly. So we've seen a number of capital raisings from those companies, and it's been a good place to be short in terms of long short and not own a lot in terms of the long only product being a Solaris Core product.
Yeah, let's try get two more questions in. Blake, there's a lot of hype around decarbonisation. Are you finding attractive opportunities exposed to decarbonisation that aren't overpriced?
This is a great question because, decarbonisation is a major theme. What's really kicked it off has been the US IRA, Inflation Reduction Act. We're in the US recently, we're in Europe as well. And, decarbonisation spend is growing very strongly. Now, as an investor, not only do you want top line, but you really want to focus on bottom line as well and make sure that if you're going to invest in a theme, as it were, you want to make sure it's profitable. And part of that would be having a good position in an industry. An example where we can't find any opportunities would be something like hydrogen. Some of the electrolyzer businesses as well, really struggle to see how some of these companies are going to make money. Another one would be EV chargers. So we met with some companies recently in Norway who are building out EV chargers and they're just not making any money. Now, where can you make money? I think in the raw materials still, you're going to see demand for those raw materials. it's almost like the picks and shovels, and also the service providers. A company like Worley is the old Worley Parsons business. They've pivoted to be more decarbonisation, sustainability, gas as part of that as well. And they're seeing immense demand for their services at a time, really importantly, at a time when their competitors have been withdrawing from the market or increasing prices materially. So, I think Worley would be a good example of a company who's going to benefit on the top line, but also importantly benefit on the bottom line.
And Michael, a final question here for you. Growth versus value. Has the D-rate we saw in 2022 finished?
Yeah, thanks, Jared. We saw a significant D-rate in growth companies during 2022 from a sort of nosebleed level, as we call them. And during that time, we were quite underweight growth companies. They went from a collective P, I guess you'd call, from about 45 times down to 25 times. So significant D-rate. And in that whole process, some interesting companies came out of it. And for us, companies like Cochlear, Sonic, those sorts of companies look really interesting, and we added to the portfolio in those particular companies. So we believe it's come to an end. They came down because of interest rates going up. Fundamentally, growth companies typically have better balance sheets than some of the other companies in the market, and so they should have less impact to rising rates. And so to see those companies derate as much as they did provided many, many opportunities. And so we do feel like there's a base now in terms of the growth companies.
Yeah. Okay. Michael Bell, the CIO of Solaris Investment Management, and Blake Henricks, Portfolio Manager at Firetrail. Thanks so much. Sorry we couldn't get to all of your questions. If you do want to have your questions answered, you can email distribution@pinnacleinvestment.com. We'd love to hear from you. Thanks, Michael. Thanks, Blake. And thanks to everyone who has tuned in.
Thank you.
Yeah.